everyone. My name's Andrew Hamilton. I'm the president of NYU, and it's my very great pleasure to welcome you all to this evening's very special event. And NYU has an exceptionally accomplished and talented board of trustees who play an essential role at the university. But for the most part, our trustees' hard work takes place behind the scenes. It's not often that we get to hear firsthand the prodigious expertise gained over the course of our trustees' remarkable careers. That's why we are thrilled that today the legendary economist, NYU trustee, Stern School of Business trustee, and NYU alumnus Henry Kaufman has offered to speak to us about his newest book, The Day the Markets Roared, How a 1982 Forecast Sparked a Global Bull Market. And tonight's event also features two of Stern's distinguished faculty members, Kim Schoenholtz and Richard Berner. In a few minutes, Professor Schoenholtz and Dr. Kaufman will engage in a fireside chat. And then following that, Professor Berner will moderate a panel with fellow leaders of Dr. Kaufman's economics team from his tenure at Salomon Brothers in the 1980s. Together, they will discuss Dr. Kaufman's impact on financial market research, as well as his influence on their own views of current economic, financial, and policy developments. Thank you very much to all of today's eminent speakers for joining us this evening. And now it's my very great pleasure to introduce our guest of honor. Dr. Henry Kaufman is president of Henry Kaufman and Company, a firm specializing in economic and financial consulting. Before founding Henry Kaufman and Company in 1988, Dr. Kaufman spent 26 years at Salomon Brothers, where he was managing director, member of the executive committee, and in charge of the firm's 4 research departments. He was also a vice chairman of the parent company, Salomon Inc., and previously he was in commercial banking and served as an economist at the Federal Reserve Bank of New York. Beyond his extensive professional achievements, Dr. Kaufman is active in numerous public and charitable organizations. At NYU, he has served on the University Board of Trustees since 1995 and as a member and chair emeritus of the Stern Executive Board. He also serves on the boards of Tel Aviv University, the Institute for International Education, the Jewish Museum, the Economic Club of New York, and the International Advisory Committee of the Federal Reserve Bank of New York, among many others. He's the naming benefactor of NYU Stern's Kaufman Management Center and also of the Upper West Side's Kaufman Music Center. Dr. Kaufman earned a BA in economics from NYU in 1948. Everyone has a blot on their curriculum vitae, and Henry also has one, but we'll forgive him for going uptown to Columbia in 1949 for his master's. Luckily, he saw the light and returned to NYU, earning his PhD in banking and finance from the then Graduate School of Business Administration, now NYU Stern, and he received his PhD in 1958. He also received an honorary doctorate from NYU in 1982, followed by honorary doctorates from Yeshiva University and from Trinity College. In 1987, Dr. Kaufman was awarded the first George S. Eccles Prize for Excellence in Economic Writing from the Columbia Business School for his book, Interest Rates, the Markets, and the New Financial World. His other books include The Road to Financial Reformation, On Money and Markets, A Wall Street Memoir, and of course, The Day the Markets Roared, which he'll be discussing with us all today. In The Day the Markets Roared, Dr. Kaufman offers a first-hand account of that day, that special day in 1982, that would come to define US economics for decades. He himself wrote a memo that sparked the tremendous economic boom that occurred that day, marking the start of almost 4 decades of US growth and prosperity. In the book, Dr. Kaufman reflects on the lessons of that historic episode, hearkening back to a more optimistic moment in American history and offering inspiration for better times ahead. And now, to get the conversation started, won't you please join me in welcoming Kim Schoenholtz, the Henry Kaufman Professor of the History of Financial Institutions and Markets at NYU Stern and Director of Stern's Center for Global Economy and Business. Professor Schoenholtz, over to you.
Thank you very much for that fabulous introduction, President Hamilton. And good afternoon, Dr. Kaufman. Thank you very much for joining us today to discuss your new book, The Day the Markets Roared. To kick off the conversation, I'd like to begin with a question that would be of special interest to our audience of NYU students, faculty, and alumni. As President Hamilton mentioned, you obtained both your BA and your PhD at NYU. How did your education at NYU affect your career and your approach to financial research?
Well, let me first of all thank the president for making those very generous remarks. And I also want to thank David Cecilia, who collaborated with me on this book. He is a professor in Maryland and has been exceedingly helpful to me over the years. Now, what was your question, Kim?
This was about your education at NYU. How did your education at NYU affect your career and your approach to financial research?
Well, I started at University Heights. That's where NYU was when I went to school. Most people there went pre-med, pre-law, pre-dental, or engineering. I thought at first I would go to pre-med, but my view was changed when I was heating a test tube in a chemical lab, and my professor was standing next to me, and the chemical shot out and hit him right on the chest. And as a result, of course, that detracted me, and I took a course in economics thereafter, and which generated really my interest in business and finance. Now, I should say, I then went to Columbia for a master's, and then went back at night to take courses and to write my doctorate. I was very fortunate at that time to study under a professor who was very, very well known, called Marcus Nadler, at the school and in the business community. He was an extraordinary teacher, had an extraordinary following, and had a great impact on my career. So let me just demonstrate the impact that he had. I wrote my doctorate under him, so he got to know me and I got to know him. And I went to him for advice periodically. When I was at the Federal Reserve, the head of research approached me and said, "How would you like to go to Lebanon for 2 years? They want to set up a money market and central banking facility. And you've been in banking, you've been now at the central bank." And that seemed quite romantic. My wife and I, we were married, didn't have children, go there for 2 years. And I went to see Marcus Nadler, my academic mentor. And he said to me, "Listen, you're going to come back in 2 years. Who will want an expert on the money market in Lebanon? And you will have lost 2 years while those who were with you at that level will have advanced." And that was very sage advice. I had an instance for when I was at the New York Fed, where the then well-known Smith Barney, it doesn't exist anymore, offered me a job. And I went to see Marcus Nadler again. And Marcus Nadler said to me, it's a very good organization and your compensation is very attractive. But he said, you will never, ever be a partner in that firm because of my Jewish affiliation. And I didn't take the job. Now, I'll tell you another incident where I did get the offer from Salomon Brothers. And I went into his office and he said, I know why you're here. You got an offer from Salomon. And I said, well, what do you think about it? And he said, well, you can make a career at the Federal Reserve and that'll be very nice. But if you want to try your hand in investment banking, this is about as good a place as possible. And I said, why? Well, you'll quickly find out whether you'll sink or swim in a competitive organization like that. And number two, at Salomon Brothers, you can hear the cash register ring every minute of the day. And that was a very profound observation, which was true. And that's how I really got to Salomon Brothers. Now, I'll tell you something on the academic side that he said to me. As I was doing my doctorate under Marcus Nadler. And he called me one time and said, I understand you're going to have your orals. As all of you know, you take a 3-hour oral, at least I took, in front of 6 professors. And I went in to see Marcus Nadler, and he said, now look, you're going to see each one of these 6 professors, introduce yourself, and then you're going to read everything that they ever wrote. And now as a final bit of advice, he said to me, they're going to ask you questions, and you have to answer. Now, when they ask you questions, you have the right to think about the answer. And number 2, you have the right to speak slowly. And the more you think about the answer and the more slowly you speak, the less questions they're going to ask you, which was a very practical observation to say the least. And so I had formed a very, very close relationship with Marcus Nadler, and he really became my academic mentor, and it really showed to me how important teachers are and academicians are when it comes to the relationship with their students. He took a lot of care to talk to his students, to advise them. He had a course on current economic and financial problems that each week was attended by 300 students. Part of them were matriculating, part were students that just came back, non-matriculating anymore, year after year after year, to hear his views on current economic and financial problems. So he played a very dominant role in my career, academically, as well as in terms of where I went and what I did. And it points out really the important role that teachers play in the life of a student. I had a conversation with Bob Cavish about a year ago, who, of course, is known at New York University, and he told me that he taught something like 15 to 17,000 students. Now, can you imagine if you just have a little impact, 1 or 2% impact on those students? You've really had an achievement that's difficult to calculate and value. Anyway, that's the answer to my question.
Thank you, Dr. Kaufman. So let's turn to your new book, The Day the Markets Roared. This is your 5th book. Your earlier books included reflections on the evolution of financial institutions and markets, as well as a memoir of your Wall Street career. What motivated you to write this latest book, and how is it different from the earlier ones?
Well, it all started when my secretary, Helen Katcher, came in to my office and said, we have to do some house cleaning here. And she brought in a lot of albums with press clippings, all kinds of interview information, thick albums. Each one had a year, but one year, 1982, had 2 fat albums. And I started to look through them and I realized that August 17th, 82 was a day I made some news, but I more or less had forgotten about it. And I leafed through all the press clippings and the info about that day. And I realized that I should write something about it. And together with David Cecilia, we formed an outline. And here's the book about August 17, 1982, what led up to it, what happened immediately after, and some other commentary.
So in the years before 1982, before August 1982, you anticipated a large upward trend in US interest rates. Why were you bearish for so long?
Well, I came to the conclusion for quite a while, monetary policy in the United States in the early 70s through the mid 70s was in disarray. The head of the Federal Reserve at that time was Arthur Burns, an ordinary, a really highly skilled academic in business cycles. He had served as the chairman of the Council of Economic Advisors and so on. But nevertheless, he could not come to grips with the increase in the inflation rate. And he had a linkage to the President of the United States that he couldn't break. He couldn't counter anything that the president wanted. And here was this skilled academic, highly knowledgeable, was going on and let the inflation roar in a way. And it was only late in the 1970s where Paul Volcker came in and put the restraint on the monetary system that righted the American economy and financial system again. And indeed, I always thought that when President Carter appointed Paul Volcker as chairman, and Paul did say he would have to raise interest rates, but President Carter never asked how much. If he had told President Carter how much he was going to raise rates in order to stop the inflationary pressures, I'm not sure that President Carter would have nominated him.
So the book highlights the market impact of your August 1982 memo, which predicted that the interest rate decline that had begun in 1981 would continue. What factors drove your change of view?
Well, forecasting and economic analysis to me is not completely a matter of crunching a lot of numbers. It's very important to crunch numbers, but nevertheless, when you do crunch them, you have to put them in perspective. You have to think about what's different today from the past and how will that alter things. Well, when I changed my mind back in 1982, you have to remember that was a period already where Paul Volcker had come along and tightened monetary policy a lot. He just let interest rates, short-term interest rates go up and up. He stated to the public at large, I'm becoming a monetarist, which was, of course, the view of monetarists at that time, let interest rates go up. And Milton Friedman really must have been shocked when Paul became a quasi-monetarist for a while. And that quick rise in interest rates, I think, frightened the market, constrained the market. The market is never really frightened when you announce policies of moderation in tightening, moderation or easing, but moderation in tightening. No, you have to put your fist up against the market, and then the market will listen. And the market did, as such. I remember, to tell you an anecdote, at Salomon Brothers at the time, we had become the underwriter for IBM. It had been Morgan Stanley, and we had won it, and it was up to us to bring a $500 million bond issue, the first bond issue for IBM, and we priced it. I got to get rid of this call. Just turn it off. We had priced it at 8 basis points above U.S. governments. And Paul, we did it on Friday on that weekend, It was called, it was a real massacre. Paul just said he became a monetarist, let interest rates go up. And by the end of the week, we were down 5 points on 50 and $500 million, which was a lot of money at the time. But the relationship with IBM paid off in the long run, and Salomon Brothers knew how to take a loss and went on. But it was I don't think you can fully appreciate what markets were like at that time, how erratic they were at the time, and how deeply embedded inflationary expectations were in the system. And I have to give credit to Paul Volcker for putting a lot of pressure on the market to bring it back to a level of sanity.
So why do you think financial markets reacted so strongly to your memo? Could you imagine that a change in a private forecast would have such a large impact today?
Well, I've thought about that, but I believe it was due to the following. My views on the financial markets were well known for more than a decade. As some of my associates here know, we had a weekly comments on credit, which was distributed to 20 to 25,000 readers every week. I tended to write the front page on monetary and fiscal policy. Early on, I wrote all of it, but later on, many of my associates who are here contributed substantially. We also published annually a document called Prospects for the Financial Markets, which was really the supply and demand for credit analysis in the marketplace. Who were the demanders of credit, business, households, corporations, state and local governments, US government, and who were the suppliers of funds, and how much eventually would the individual investor have to contribute in order to finance all the demands. The trick was to do this in a detailed analytical fashion. The Federal Reserve had published a flow of funds analysis, but never put it into a market orientation, which we did. And the question always was, to what extent does the household itself have to come in to finance open market credit financing? And that I actually went at that not by making my own forecast. In the early years on economic activity, I had to hinge it off an economic forecast. But in the early years, I took a consensus economic forecast and tried to determine what the credit demands would be, who would finance, and what would households do. And that became a popular document called Prospects for the Financial Markets. Some of my associates that are here on this program today remember it. It was widely distributed. We actually released it to a wide audience, usually January, February, where we had a large audience at the Waldorf in New York, and we hooked in London, and we hooked in Asia for that broadcast. So those documents, Prospects for Credit Markets, weekly comments on credit, most of the time when I had to give a speech, I didn't do it off the cuff. If the audience was more than 100, 200 people, I wrote out a speech. And I find writing out a speech is a very good discipline on your thinking. When you just chat with somebody or in a group, make comments, you don't fully appreciate the potential errors you can make. But when you write out what you really believe, you all of a sudden come to the corner of saying to myself, that isn't working out right. So there was great value in writing out a speech. First, you knew exactly what you said. And secondly, there was the discipline of knowing how to say it.
So you first told your Salomon Brothers business partners about the memo and its contents only after publishing it and when the market reaction was underway. How did they react?
Well, that day was an unusual day because I had written out my views on a Monday evening, or I started on the weekend. Started on the weekend, and I continued to write my views on, finished it on Monday evening, and I gave it to my driver to bring to the office at One New York Plaza to my secretary to transcribe it. And we had an executive committee meeting at that time in the Waldorf that day. And I asked my secretary, Helen, to call me after she had written it out to read it to me again, and at the Waldorf. Call came in about 8:15, 8:30. Somebody said, Helen is on the phone. She wants to talk to you. She read it to me and made a few corrections. And it took about 10, 15 minutes, came back to the meeting at the Waldorf, and John Goodfriend, with the managing partner at that time, said, what was that all about? So you kept us sitting here 15, 20 minutes. And I said, well, I had an important memo. And he said, what about? Well, I changed my view on the market. And with that, everybody in the executive committee's ears perked up. What do you mean you changed your views? Well, I feel that interest rates are going to go down quite a bit from here on. And they said, you said that? And I said, yes, I said that. Well, you didn't mention it yesterday at the Monday morning trading and sales meeting. I said, I wouldn't do that at a Monday morning trade meeting. We release our information to the firm and to clients at the same time. Well, okay, we sat down, and all of a sudden, half an hour later, the bell rang, the telephone rang. John took the call. Oh, the market is up. 15 minutes later, he gets another call. Oh, the stock market had opened and the bond market is open. You should see what's going on down here in the trading room. With that, we stopped the executive committee meeting, and we went down on August 17th that morning to the trading room, and there was a great flurry of activity. It was like bedlam, and that's how the whole thing started.
So that brings me to one of the themes in the book, your focus on the integrity of financial market research. Why is that integrity so important, and how did you manage to guard the financial researchers in a world of widespread conflicts of interest?
Well, Kim, that's a very good question. And I think there is a simple answer to that. Research should be represented at the highest level of an organization. You cannot have a proxy. If you have, for example, the head of research reports to the investment banking head, or the head of research reports to sales head, or so on down the line, that is not protecting the integrity of research. If something comes up that disturbs somebody in sales and trading and investment banking, it'll come up in the executive committee, and woe, the individual in research that doesn't have somebody there representing him. I've seen that happen a number of times. We had in the firm a very good banking analyst. And when Walter Wriston stepped down, he was called for an opinion. And he blurted out to the Wall Street Journal on front page, I'm quaking, I am shaking, what a mistake they made. Well, somehow we had an executive committee meeting that morning, and I walked in and they all said, well, what are you going to do about it? And I said, I think you're expecting me to fire the man. I'm not going to fire him, but I'm going to talk to him how to speak to the press, at least not in that tone. But that was the end of it. Yeah, you can imagine if somebody if research was not represented at the head of the firm, what would have happened to that individual? Would have lost a very good man, would have lost a very good analyst. And it was forgotten after that. And it's very dangerous when research is subordinated to the senior management. research should be represented on the senior management. And I don't know where else that took place. I really think, I don't know of any other large, major investment banking organization where the head of research was also in the senior management. But I think that's what it should be.
So when you joined Salomon's fixed income research team in 1962, it employed 7 persons. Over the next 2 decades, it grew to be widely regarded as best in class. What were the key factors in the success of fixed income research at Salomon?
Well, the first was the firm hired a man by the name of Sidney Homer, who had written a book, A History of Interest Rates from BC to the Present Time. Now, he was in the financial markets, in managing money. He was not a trader, but he was a scholar also. And I'll tell you just a little anecdote. When I got into Salomon Brothers, we were at 60 Wall Street, and Sidney Homer had just finished and had the galley of his book, The History of Interest Rate. He came into my little office at the time and said, "Here's the galley of my book." And I said, "What would you like me to do?" "Well, I have 2 galleys. One I want to give to your secretary, and you've got the other galley. And what would you like me to do?" And he said, "I'd like you to read it out loud to her." And I said, "Why do you want me to read it out loud?" And he said, "Well, you will spot errors in phrasing, errors in spelling, errors in punctuation, much more so than if you just sit there and read." So I will tell you, I'm the only individual that ever read that book from the beginning to the end, 575 pages, with statistical tables out loud. No one else ever had to do that. And Sidney Homer wrote in the book, copy of the book he gave me, he wrote that. The only person who ever read it out loud. And but Sidney Homer was an extraordinary mind. He left the money market, the interest rate side, and so on, a lot to me. He looked more at longer term issues, but he was a great financial historian, a prolific writer, and he allowed me to do my thing. It's very important to allow people that work for you to do their thing, so to speak. Don't constrain them. Let them get along. I came into Salomon Brothers in January of 1962, and Sidney in June called me in and said, "You know, Henry, I'm going to the Adirondacks usually for 2 months. We'll do some reading and studying, but in the meantime, it's up to you and Dick Johansson to do the weekly comments on credit, the bond market roundup, and the comments on credit, and the monthly bond market review." He just dumped it on me. I hadn't been doing it, and he went away. He let me do my thing, or he encouraged me to do my thing, so to speak. And that worked extremely well for the 2 of us.
Okay. In the book, you discuss important problems in the securities markets, including issues regarding marketability and funding liquidity. What are your concerns about marketability and funding liquidity?
Well, the term marketability is really overdone. And it's overdone by financial analysts and by financial institutions, because what they will say, these assets are marketable. And what do you mean by marketable? You mean to say you have assets here that total $20 billion, and those assets that you had marked to market by somebody has come along and said, these are the prices, blah, blah, blah. I know how these things get priced. I saw it at Salomon Brothers. We used to get a whole reams of papers of holdings of institution to price them. And I saw the trader go, blah, 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 blah. Are they really tradable? There's 10 or $20 billion at that price? And the answer is no. only a small fraction of that entire portfolio of $10 billion or $20 billion could be brought to market at any time. A very small fraction. And most of those obligations lie dormant in the institution anyway, because you can't bring them to market in that sort of fashion. It's a little bit here and a little bit there, and then it's deemed marketable. That isn't really true at all. When it comes to liquidity, think about the old terminology of liquidity years and years ago in banking. Well, liquidity is something that you can move into cash very quickly, an asset. Well, ask yourself, there are a huge volume of treasury bills outstanding, huge. Are those short-term liabilities of the US government? Or are they really long-term liabilities of the US government? The expectation is when those treasury bills come due, they get rolled and rolled and rolled. They really are long-term liabilities. Can you imagine if the US government had to liquidate half of its treasury bills? How would it do it? Or even the commercial paper that's outstanding in many corporations. So marketability and liquidity, these are terminologies that have been modernized by today's financial markets and participants.
So one of the long-term trends that you often highlight is the decline in creditworthiness of the US corporate sector. Why is this pattern so important for your outlook on the economy and interest rates?
Well, the dilemma is that the credit quality of corporations has been deteriorating practically decade after decade. And it looks like it's going to continue to increase. The number of AAA, AA, or A-rated corporations have diminished. Those with BBB and below, the number and the volume has increased. I think that will continue to be the case. Now think about it. In my day, in the 1950s, early 60s, AT&T telephone company was considered a blue chip. And everyone who owned AT&T stock considered it guaranteed for the rest of the dividend was guaranteed for the rest of your life. That's not true of AT&T anymore today. Unbelievable how this has changed in 4 or 5 decades. The decline in credit quality is really continuing. Ask yourself the question, how do you improve credit quality? If you know of any business chief of financial, a head of finance in a business corporation who will say, my priority is to improve the credit quality of outstanding bonds. No one. Why not? Well, if you leverage more and leverage more, the rate of return that will come to the bottom line increases. And somehow this has worked up to now, and there have been not too many casualties. If more and more of us become below investment grade or BBB, it'll go on. And indeed, the spread between BBB or junk, between BBB and A is modest. I think if you ask yourself, though, suppose you wanted to really improve the credit quality of debt, what would it take? It would take the write-off of a lot of outstanding debt. The write-off. Now, how do you write it off? Well, under duress. You need a depression. However, today we have a central bank that says we will not allow a recession, certainly not a depression. So natural forces cannot write it off. And in that sense, the central bank has to play an ongoing, increasing role in managing lower credit quality obligations, one way or the other. A year or so ago, the Fed said it will buy low quality bonds, but the mere saying that it will buy low quality bonds, stabilize the market. It didn't buy many. Yeah, whether that will always be the case, that's a different issue. But it dipped its foot into that area. It didn't want to allow the financial market to re-gear itself. And even in dealing with the airlines here, the government gave loans to the airlines. Well, it could have said to the airlines, go to Chapter 11 and you can continue to operate, and we'll make adjustments with your creditors. You're a debtor. No, we are not wanting to allow a financial adjustment. And if you don't allow a financial adjustment, you keep moving along with the, say, lower quality obligations.
So generalizing from what you've just said, what about the creditworthiness of the US government? Do you think rising indebtedness will lead to a decline in the credit rating?
That's a very good question. And I would say this is a very difficult problem for Standard & Poor's, Moody's, and Fitch to think about lowering the credit rating, not only of the US government market, but some of the European obligations and so on. I think that is not going to occur very soon, even though there ought to be some writings by the agencies about the need to maintain the credit quality of government debt. It hasn't even said boo about it at the present time. And there was, a number of years ago, there was a mention that the credit rating of US government obligation were going to be a touch lower, but nothing has been said since. I really doubt whether the agencies will take any position in that for the next couple of years.
So over the last 15 years or so, since 2007, we've been through quite a few major financial disruptions. Do you think the financial system today is more resilient than it was before the financial crisis and before the pandemic? If not, what do you think needs to be done to make it more resilient?
I don't think it's more resilient. The way what the U.S. government has, and the Federal Reserve has done, is put a ring around the major financial institutions, which are deemed too big to fail. And that's a pretty good position to be in if you're JP Morgan, if you're a Bank of America. That's not bad. During periods of economic expansion, monetary ease, you can make a lot of money. And if things get very tight, the Federal Reserve says, you're too big to fail. That to some extent means whatever is left of other other banks, their role is really becomes insignificant in the system. I know politically there are always comments, we have to help the smaller banking institutions. I don't think. I think that is lip service rather than doing anything purposely for the smaller bank. Think about it in this way. There are 70,000 branches of financial institutions in the United States. Huge. And then all of a sudden it became, through the pandemic and helping small business, where were these branches that were located all over the place? I would argue, if you did some research and a survey was taken, many branches of banks are for the purpose of gathering funds and shifting them to the main office. They are not for the purpose of financing the local community. And I'm not talking about making auto loans, for example, or consumer loans. I'm talking about financing the business organization and the smaller enterprises in their area. I don't even bring me on that subject because when I first joined the Fed in 1957, the Fed was starting a survey on small business finance. And since I had worked in a smaller bank and then in a larger bank, they got me involved in this. And out of it came the recommendation and the creation of the SBA. Why should there be an SBA when you have 70,000 branches in the United States? Why not ask these branches, what are you doing for the local community? How many loans have you made to businesses? Not how many car loans or mortgage loans. How many loans have you made to businesses in your community? What kind of loans have you made to them? And so on. No, there's every facility around to accommodate those smaller organizations. And there's no need for an SBA, which hasn't functioned well anyway, to start with. Why should we have an SBA when there's 70 some odd thousand branches? No one has ever answered that question. But we tried to rely on the SBA to make small business loans during the pandemic. It's turned upside down.
So you mentioned too big to fail. The question that follows, I think, is, are large financial conglomerates now too big to manage? Should we break them up?
Well, as you well know, my view is they should be broken up, because I do not understand how you can effectively manage underwriting, the management of money, making loans of all sorts to different parts, having an international presence. I think all of that is a responsibility over which good judgments cannot be made. You're so much dependent on people under you that it is very difficult to manage. I have long argued, take the big conglomerates, to the extent to which they manage money, make them investment institutions. To the extent to which that they're in consumer loans, put them in consumer lending and mortgage lending. To the extent to which they're on the business side, make them commercial banks. And we have conglomerated, not because of the wisdom of the central bank, but because of the failure of the central bank to understand the restructuring that is taking place in the financial system. Isn't it surprising? Here's the central bank that is supposed to overlook the well-being of our financial institutions and banks and so on. Where have they been in the last 20 years? Didn't they realize that there was a huge consolidation taking place, not only within the commercial banking side, but where these conglomerates pulled in everything else under one roof? Aren't there conflicts of interest that are many here that you therefore shouldn't really countenance? The central bank has not said boo about the consolidation that has taken place. And in fact, I think they somehow believe it's easier to deal with 10 banks or 5 banks than with many, many banks out there. And it's one of the great faults of monetary policy. They have a much broader responsibility, but they have shied away from it.
So let's turn a little bit more to the Fed and to your views. You've mentioned already that thinking about last year, you viewed the Fed as effectively bailing out the too big to fail banks by promoting excessive risk taking. Broadly speaking, how do you think the Fed did in managing the COVID shock last year?
I think the Fed overreached. The Fed overreached. It really came to the conclusion it will do everything that can be done through monetary policy to help overcome the pandemic. There are limits to what you can do. And if you go beyond this, you change the role of central banking and you change the role of your relationship to the federal government. And I think that's what the Fed has done. It should have said to the government, yes, we will bring interest rates down to very low. We will be accommodating, but that's about all we are going. We're not going to bail out businesses per se. There is We have Chapter 11s. These businesses can stay in business. The Federal Reserve was mute on the issue. And I find this current situation a little dangerous because the chairman of the Fed is one thing, and the Secretary of the Treasury was also a former chairman of the Fed. That is a very close relationship where I'm beginning to wonder the extent to which the Federal Reserve can maintain its quasi-independence.
Okay, so we're in a period of extraordinary fiscal and monetary stimulus, and we're entering a period of rapid economic growth. But the Fed is forecasting only a mild and transitory rise of inflation. Do you think they're right in their forecast?
Well, I really don't know, but I think the Fed is willing to take the risk. And I think that's a dangerous thing to do. It's willing to let the inflation rate go up to 2.5% for a while and still not make a move. I would think the Fed should be more cautious in dealing with the period ahead. We're already ramping up the economy right now, and that is continuing. We see in the first quarter, it's going to continue in the second quarter, and there's an expectation of strong economic activity in the second half of this calendar year. That requires the Fed to be somewhat more circumspect about what it says about inflation. Now, it's dangerous to say there is an inflation rate coming that is transitory, that it is because of the comeback of the economy from the pandemic. That's a forecast that is made on analysis, I think, that is suspect. And I would, if I would be there, and I'm not, I would say the Fed will not tolerate an inflation that is unacceptable to economic growth. I would phrase it more that the Fed is aware, rather than saying, we'll go to 2.5%. We won't go to 2.5%. We want to make you aware we won't tolerate a high rate of inflation. And if it comes up in the second half of the year, we may have to consider what we're going to do about it. The Fed doesn't speak in that language.
So let me come back to NYU and even more specifically to NYU Stern.
Yeah.
You're one of the business school's most famous alumni, as well as one of its great benefactors. What advice would you give Stern students today who are thinking about careers in finance?
I think, just based on my own experience, where you begin is not where you're going to end. And don't be afraid of where you begin, but have some path in mind and keep wanting to go onto that path. But the first assignment you're going to get is not really the last assignment. Well, let me just illustrate this. I got out of Columbia with a master's, went to school at night for a doctorate at NYU, and I started my work in an industrial bank on 6th Avenue and 30th Street. And I became credit manager, then Manufacturers Hanover took it over, and I stayed there a little while and then went to the Fed. But that experience that I got in the industrial bank and as a credit manager was a very useful insight in the financing of business and how risks are to be judged. So where you begin is, don't say that's where you're going to end. Where you begin is one thing, but think about where you're going to be next and where you're going to be next and so on. Keep that road in mind, but don't say, I got to be on that road every minute of the day. Be somewhat flexible. And to be sure, I remember when I got my degree at Columbia, I wanted to go into Wall Street immediately. And it was very difficult. There were no, in 1949, when I had my master's, there were no headhunters around. from Goldman Sachs, Salomon, Morgan Stanley, and so on. That occurred 10, 20 years later, 20 years later. And so I worked in an industrial bank, in a commercial bank, in a branch. And I will tell you again, I may not have said this before, I was getting closer to my doctorate, and I was still at Manufacturers Hanover in a branch. And I wrote this blind letter to the Fed looking for a job while I was in Manufacturers Hanover. And to my shock, I got a response. But I had mentioned my academic mentor, Marcus Nadler, who was known to the people at the Federal Reserve Bank of New York. And that's how I got the interview at the Fed. And that's how I got that job, really. But don't be blindsided. Start, but keep in mind where you want to go. And if it isn't the beginning, if it isn't the first job that's going to bring you to the end, there'll be many intervening steps. And that is what really happened to me, and it happens to many other people.
So this has been a great conversation, and we could, I'm sure, continue for a long time. But is there anything specific that you'd like to address that I haven't asked about?
Well, you're a very good questioner, and you're one of my famous colleagues at Salomon Brothers, and you cover the waterfront always. No, I would say where you begin is not where you end. Just keep everybody who. That is what I will tell you what my career was all about. Let me put it differently. In 1937, when I was 10 years old, I came to the United States. Now, at that time, when I came to the United States, I was 10 years old, and my mother took me to PS 23 in the Bronx, and the principal quickly realized I didn't know any English. So I was in the first grade and the tallest child, and with no English. But that's where I began. And just where you begin is not where you end. And it is one of the great benefits of being in this country, that the road is relatively open to most people. But you get on the road and you keep marching, and you take detours here and there, but you keep in mind where you want to be. And the opportunity is in this country. That's why so many people still want to come here. Now I have a certain problem with all of this. Every time I come from abroad and I land at Kennedy or wherever it is, and I look down and I say, God, I could have been in Germany instead of landing in the United States. Boy, oh boy, did I land up in the right place. And you land up in the United States, you're in the right place. And everybody recognizes that. There are huge opportunities here, huge benefits from being an American. So that hasn't changed at all. Why do so many people still want to come here? Because it is the place to be.
That's a wonderful way to bring this chat to a close. I'm sure the audience shares my gratitude, Dr. Kaufman, for this excellent conversation. So let me now just take a moment to introduce Professor Richard Berner, who will moderate our panel of experts. Dr. Berner is a clinical professor in Stern's Department of Finance and co-directs the school's Volatility and Research Institute. Professor Berner came to Stern following careers in both government and business. He was the first director of the Office of Financial Research. He served as counselor to the Secretary of Treasury. Chief U.S. economist and co-head of global economics at Morgan Stanley, and in senior research roles at Mellon Bank, Salomon Brothers under Dr. Kaufman, and at Morgan Guarantee. Earlier, he was an economist at the Federal Reserve. Dr. Berner is past president of the National Association for Business Economics. He received his PhD in economics from the University of Pennsylvania. Over to you, Dick.
Well, thanks, Kim, for that very kind introduction. I want to say that we're here to celebrate Henry Kaufman's important contributions to thinking about financial markets, financial regulation, monetary policy, and global affairs. And on this panel, we're also here to express our deep gratitude to Henry for his leadership, his mentorship, his friendship, and being a role model for us, all of which changed our lives for the better. Bob DiClemente, John Lipsky, and Nick Sargen, all of whom you see here today, were my colleagues in the 1980s at Salomon Brothers under Henry's leadership. Bob joined Salomon in 1975, if I have that right, well ahead of the rest of us. His market and monetary policy wisdom were really beacons for us. He sure wasn't afraid to speak up and buck the consensus, and that, as you've heard before, was something that Henry encouraged. International economists John Lipsky and Nick Sargen came to Salomon Brothers in 1984 from, respectively, the IMF and JP Morgan. Henry recruited them because he realized that understanding global economies and markets was critical for analysis and for Salomon's business. Now, Henry's ability to attract talent reflected the values that he embodied that made him special, and of course, especially to all of us. First, he had strong views, but he always welcomed alternative views to challenge his, as long as they were based on facts and analysis. And when others around us were frenzied, he always asked the right questions to ground us. Second, his work was influential, not just because he was right, more important because it always had integrity. Third, his humility and his humanity were and are apparent in everything he does. Fourth, in respecting and trusting us, he protected and stood up for us when it came to confronting the inherent conflicts of interest between traders' positions and the integrity of research. Those values built Salomon's bond market research into the premier source of financial research. And those values have stayed with the four of us and made us better. And in Henry's own words, where you begin is not where you end. So Bob became chief U.S. economist at Citi. John returned to the IMF as first deputy managing director. Nick went to Fort Washington Advisors as chief economist and chief investment officer. And I came here to Stern, Henry's alma mater. More than 3 decades later, we still hold those values. We're still friends, and we're still learning from each other. So now it's time to put questions to my friends here, starting with the day the markets roared. And of course, I know they won't be shy about turning to me to ask questions. You may hear some overlap between what Kim just talked about with Dr. Kaufman, with Henry, but I want to get their perspective. So let's start with that. Why do you think Henry's August 1982 call had such a large market impact? And Bob, you were working with Henry at the time. What did you see as the main factors?
Well, thanks, Dick. First of all, I want to congratulate Henry for the book, and also congratulations for remaining so vital on so many issues that have inspired all of us over all these years. It's so glad to see you all today. Obviously, on your question, Dick, I think one of the factors that was at work that day in 1982 was, what we used to call the man bites dog aspect of Henry turning bullish. He brought so much credibility to the rate debate because he was so grounded in his analysis. I think, as much as he may have been an inveterate bear, he got it right for all the right reasons. I wanted to start this off by providing one, I think, powerful illustration of the analysis that he did, drawn from an episode in 1978, actually. And that surrounded the seemingly innocuous introduction of money market certificates or savings deposits that were tied to 6-month Treasury bills. The episode, it always stuck with me for how, it separated Henry's approach from that of others. And just to set the stage, inflation was rising pretty steadily at the time. So the demand for credit was mostly inelastic. Credit expansion was largely a function of availability. And we were 3 years plus into a recovery at a time when it was not unusual for expansions to end in 4 years or 5 years. So a lot of people, including regulators, were growing concerned that with rates going up, there were risks of recession mounting. And so a relaxation to allow depositories to compete with money market funds for savings at higher rates might forestall a credit crunch. Henry read it quite the opposite way, as a new channel to sustain an inflationary spiral. So what I wanted to do today is to read a brief passage from Comments on Credit from May 12th, 1978, the lead titled Substantially Higher Interest Rates in Prospect. So if you'll indulge me. The struggle for funds from here on will intensify because the ultimate intent of this new regulation is not merely to allow higher rates on savings deposits, but to permit financial institutions to continue to provide funds to private borrowers. This is occurring against the backdrop of substantial inflationary expectations, particularly about housing. At the same time, the external financial requirements of business are increasing rapidly, and then the second half of this year will bring with it enlarged borrowings by the US government itself. Ultimately, the Treasury will still succeed in outbidding the consumer for funds, but at substantially higher rates. Thus, another very powerful fuse has been lit beneath the interest rate structure. The result is likely to be an explosion that may well carry rates in the long-term markets to new secular highs. Mind you, this episode, end quote, this episode, it's not in the book and it's not in Henry's memoir, but it's always stood out to me. It's so clear, it's so assertive, it's so unambiguous, and it really took the street to school. Of course, it was this kind of analysis that draws from his, the flow of funds framework at critical points, with an inflationary backdrop that really set the table for that summer in 1982. This was the guy who changed his mind in August of 82. Yeah, he was a little bit late, but there were much larger stakes at play in the next moving race. And I just want to point out, there's another stark contrast between 78 and 82, which sheds light on your question, Dick. And that centers on leadership and policy and commitment to a credible anti-inflation stance, which Henry alluded to. Around the same time as the Reg Q changed, the Fed voted very grudgingly to raise the discount rate from 7 to 7.25. Not only was the vote split 3-2, but the chair himself voted against it, and he had no compunction about sharing that information with the public. Later that year, the administration, I think, announced an anti-inflation program that was most notable for the absence of any role whatsoever for monetary policy. So you move forward to 1982. We're deep into the era of, what Volcker actually called the so-called practical monetarism. The money supply accelerates sharply out of the gate in 1982, and the Fed, caught in a bit of a dilemma because we're in recession, it slashed its growth target for money, which forced the funds rate up by 300 basis points, but from 12% to 15% in the space of just a few months. Now, there had been all this optimism about recovery at some point in 1982, including, I think, from the Fed staff at the time. But by the middle of the year, that optimism was gone. There had been a number of very visible accumulating signs of, correction or fragilities, I think, depending on your perspective, that were weighing on investors and analysts, including things like, the failure of a secondary dealer in governments named Drysdale Securities. There, of course, was the Penn Square Bank in Oklahoma, which was deep in oil patch. And of course, Mexico's problems in the LDC situation, which I think Nick and John will talk about. But by summer, it was clear that recovery was nowhere in sight. And over this extraordinary period from July to August, the Fed slashed the discount rate by 50 basis points every other Friday afternoon. And in those days, we came to realize that you couldn't step out early for a summer weekend or a Friday afternoon round of golf, because at 4 o'clock, there was a 50-50 chance the Fed was going to cut rates. And the Friday before Henry's Tuesday memo, marked the third of 4 of those cuts. So in that environment, where inflation was falling from, I think, around 8% to less than 4%, but even more importantly, for the secular view, long-term inflation forecasts were dropping from about 9% to less than 6%. And I think that underpinned the idea that there was a potentially more lasting change underfoot, and an emerging sense, that the Fed was gaining some credibility. I think Henry's call crystallized a growing recognition that, whatever cyclical pressures the bond market was going to encounter in the next recovery, we probably would not see a return to the 1981 highs. And that's really how it transpired. It was exciting. It was frenetic. As bedlam, I think, as Henry used the phrase. There was a massive rally that ran almost uninterrupted until fall. But there was also, around Salomon trading floor, there was some griping going on about trading sales. Why weren't we given any heads up? In those days, I think there were certainly clients who suspected we were front running, but they certainly didn't know Henry very well. I can personally attest that news like that never leaked out early, and I'm sure you gentlemen will all reaffirm that. But anyway, those are my initial thoughts on the period.
Thanks, Bob. That's great. And your answer brings me back to a couple of things. One is I was running the Fed, or helping to run the Fed forecast in 1978, when you alluded back to that period. And we were on the warpath internally about what our bosses weren't doing to address inflation at the time. It was breathtaking. And second, by the time 1982 rolled around, I was in a very different environment, but thought, thank goodness we've got a Fed chairman who is paying attention to inflation and bringing it down. And so Henry's call at the time resonated with me for that reason. But let's get a different perspective. Nick, you were at a very large, complex global banking institution, then one that's even larger and more complicated today. Do you have a somewhat different take on international considerations and the events around the early 1980s change in market perceptions?
Thanks, Dick. I certainly do. But just at the outset, since this is about Henry Kaufman, I do want to begin by saying how grateful I am that I have the honor and privilege to work for Henry for 4 years. When I think of my Wall Street career, I tell people I was a survivor of 25 years, but there's no question that the 4 greatest years were the years when Henry was our boss and we were all together. So I am grateful today, Henry, for all you did. Turning now to my recollections of the period in 1982, as Dick alluded, I was then at the Morgan Guaranty Trust Company, very prestigious bank. We thought the House of Morgan was invincible. One of my roles in the International Economics Department was to oversee the credit worthiness assessments. This wasn't of corporations, this was of sovereign borrowers from the bank. And we developed a methodology partly based on my experience at both the US Treasury and the Federal Reserve to assess where were the greatest risks in lending. And our assessment at the time, this is mid-1980s, or the early 80s, we were aware of the huge amount of lending by the commercial banks to the developing countries. We were also aware, of course, the very high interest rates and the very strong US dollar. And so when we were doing our assessments, our conclusion at the time was we thought most of Asia was lower risk compared to Latin America. But the Latin American lending officers were telling us we had it all wrong. And I still remember in early August, they came to us and we had a publication, World Financial Markets, and they asked my boss, Rimmer DeVries, could we write an upbeat story about Mexico? Because a lot of people were contending that Mexico was having difficulty. And at the time, I wasn't responsible for the article. It was time for me to go on vacation. I go to Cape Cod, and a week later, I still remember looking in the newspaper and seeing Mexico's run out of foreign exchange reserves. I'm saying, what's going on? And then as events unfolded, there seemed to be a domino, Brazil, Argentina. And I'm sitting there saying, we never imagined that this might be happening. And then, of course, toward the, I think it was the following week, was when we have the press reporting on the major change by Henry Kaufman in his view on interest rates. And while the stock market boomed, we actually thought that what was more critical was to see the decline in bond yields and interest rates, because again, we realized at the time that this was a big deal. We escaped a major problem in the mid-1970s, but this one was for real. So the bottom line, though, is I returned to the office in early September, went to my boss, then Rimmer de Vries, famous international economist, and said, Rimmer, how bad is it? And his answer to me is, Nick, I've never seen Dennis Weatherstone so scared. So who was Dennis Weatherstone? The president and eventual CEO of Morgan. And the reason is the bank realized it had more capital out to these MBAs, so we were vulnerable, but so was the entire system. And so really, I think that what I recall at the time is saying how scary the situation was and what could we do to make sure that we didn't really have a Great Depression. And in the end, Morgan did play an important role in coordinating with other money center banks to make sure that loans kept being rolled over to the developing countries. The motto was rolling loan gathers no loss. So the bottom line, though, is it had to be coordinated with the G7 governments, and then really at the center of the coordination, and John, I'm sure will talk about it, was the International Monetary Fund. So really, I would argue today that this type of coordination is no longer possible. Had it not occurred, even, we all know that there was a happy ending to 1982, but there was the risk. There could have been a much worse outcome. So I'll turn over to John now.
Well, thanks, Nick. Let me just say, as Bob said, the stakes were high in a number of respects, and coordination problems were challenging then, as some of them are still today. So, John, speaking of that, you were at the IMF, as Nick mentioned, and the global economy was still hurting. Do you share Nick's perspective on the events surrounding and following Henry's call?
Yeah, in many ways, a bit of a slightly different perspective, but pretty much in line as usual with Nick, someone who had the pleasure of working with at Salomon, and we've remained close friends ever since, and usually see the world the same way. And one of the ways we see the world the same is in our admiration for Henry and our gratitude for the letting us serve with him at Salomon Brothers. We all have anecdotes that we can say and tell about incidents involved Henry that demonstrated his integrity, his support, his leadership. In short, I think we all think of him as one of our heroes, if not our main hero. Now, back to where we were. I pulled out in preparation for today, look back to see what the IMF was thinking as we led up to August 1982. And the answer was, well, things were worrisome, but had not seen the gravity of what was about to occur. And I suspect that that's one of the reasons of why the events of August 17th were so dramatic, because essentially the situation was building for a really serious situation internationally that was going to have a dramatic impact on the American banking system, certainly the money center banks such as JP Morgan. Specifically, when you looked at the IMF's report prepared in anticipation of the annual meetings of the IMF in 1982, that took place in September, began on September 1st. Inflation seemed too high, growth was too low. The fund said the 3-year economic slowdown in the industrial countries, they called them industrial countries back then, before all the industry went someplace else. The 3-year economic slowdown in the industrial countries having had visibly adverse effect not only on their own economies, but also on the developing economies, and continued the level and movement of interest rates and exchange rates among major industrial economies, hint, hint, the United States, during the past 2 years have caused difficult problems for the rest of the world. Worried about threats of protection, and noted the combination that was going to be effectively fatal for the creditworthiness of several large, what we now call emerging market countries, then we call developing countries, were a combination, especially those we called non-oil developing countries or oil importing developing countries, was a combination of very low commodity prices, therefore weak exports, but very high energy prices. And the idea was this could be trouble. Well, the ink wasn't yet dry and the meetings hadn't yet happened. On August 12th, Mexico informed, August 12th, 1982, the Mexican finance minister called his counterpart in Washington to say that they were going to be unable to service their debts of, doesn't sound like much today, but it was $80 billion. And that alone would have wiped out the capital of the money center banks. On September 1, just a few days later, Mexico actually nationalized its banks, and the gravity of the situation became apparent since the bankers of the world, including the heads of JP Morgan and others, were gathered in Toronto for the IMF annual meetings. And I, at the time, was served in the IMF's capital markets division. And upon return from Toronto, the managing director dispatched a group of us to visit the major capital financial centers of the world to see whether the bankers were as completely traumatized once they got back home as they seemed to be in Toronto. So I could go wrong, but suffice it to say, in this context, that the dramatic response in U.S. markets was, it's easy to say it was all domestic, but in fact, the broad setting was a much more dire, both financial and economic situation outside the U.S., but one that for the first time in I think living memory, that the exposures of the U.S. money center banks to developing countries through the syndicated sovereign loan instrument threatened the stability of the U.S. banking system and required an emergency response that eventually involved tripartite action, unprecedented tripartite action of the IMF, the principal member countries that house the money center banks, and the developing borrowing countries themselves.
So I think you've heard the wisdom that I talked about earlier of Henry's hiring Nick and John to focus on global and international issues and how important they were and continued to grow in importance for not just the business of Salomon Brothers, but for the capital markets around the world. Shifting gears a little bit, another theme that we've talked about a lot in this, and Kim and Henry talked about earlier, were conflicts of interest around research and how Henry promoted integrity, both in his work and in ours. And Henry said, you know, as a boss, you've got to let your people do their thing. And he provided some examples of that. And he certainly let us do that, subject to the constraint, of course, that it have integrity and that it was based on facts and analysis. So a couple of questions for my friends here. First, has the management or the regulation of these conflicts improved over time? And what, if anything, still needs to be done? Here, I'd welcome anybody to jump in and address that question. Maybe I'll take advantage of the pause to ask a couple of others. Can firms that underwrite securities provide credible research about the users of funds? And last, if you were leading our large research team today, what lessons would you take from your experience working for Henry Kaufman?
Well, let me jump in here just a second and say it seems to me potential conflicts of interest are almost inherent in financial institutions. And I think back to how do you become a trusted advisor to your clients? Number one, you have to have advice that is worth listening to. And second, you have to be trustworthy. And that's why integrity, honesty, and consistency are absolutely critical to success, to long-term success in any business, but especially in the financial world. And I'll bet we could all tell some anecdotes about how Henry stood up for the independence of research. Could that continue? Well, I'll bet each one of us who continued on in the financial sector never forgot Henry's lesson and never let that sense of honesty and integrity be compromised. And hopefully that is with the various reforms of research, especially the role of equity research, hopefully things are better than they had been previously.
Yeah, I just follow on and say, there was no doubt that at Salomon Brothers, when we were there, bond market research was considered the premier fixed income research on the street. And I think it was a function of two things. One, just the quality of the research with Henry setting the tone. But I think that the other factor was the integrity of research. To me, what made Salomon unique is that Henry served on the executive committee. In so many other firms, research, and in fact, a lot of firms, research reports into marketing. And that was the thing, is that I don't think whenever we wrote a report, we never felt conflicted. Our job was to call it like we saw it, and it might not always be popular, but we always knew that if there were complaints, that we would have Henry's backings. And John and I both tell the story of one of our happiest days and one of our saddest days. We had both in late 1987, December, been promoted to the title of director. Bobby DiClemente had preceded us. So we felt very good about that, but we couldn't even enjoy it for an hour, because then we were told, they called us into the room, that Henry would be leaving early the next year. And all of us were stunned. And afterwards, John and I huddled, and our conversation was, well, let's look on the bright side. We'll have added responsibilities. Okay, what's the bad news? The bad news is we won't have Henry to protect us anymore. So that shows his influence.
Yeah, if I could jump in, I don't think you can overstate the importance of a role like he enjoyed as vice chairman of the company, the very highest levels of management, and at the same time, chief economist and head of all research. As a legacy, I think, of Billy Salomon, I think Henry will verify this, but Henry had no budget constraint except the one that he imposed himself. And so I think we can all remember instances, and Dick, from the moment you joined, we were Macro Advisor's first client, just laying out whatever resources we needed to get the job done. It was just relatively easy. By the time I was winding down, we couldn't get paper clips without all kinds of requisition forms and layers of management. Being at a relatively smaller shop, when I joined Salomon, we were probably 1,000 people. but also one where you had this streamlined management and the visibility, the ultimate accountability. Just made it that much, simpler. And if you said something that was obviously compelling or maybe out of consensus, I think, as you said earlier, Dick, as long as you had your facts to back it up, you could do it. I almost hesitate to tell this story, but one of the very last projects that I worked on at Citi was involved a thorough look at the Puerto Rican situation. This is back in 2013, 2014. And, we came to some pretty dire conclusions about the likely fate of Puerto Rico. And not that it was earth-shattering, but it was important, certainly for a lot of bondholders, particularly among retail investors who might not be as informed. And that report never saw the light of day. We never got very far once it was written. And it was pretty frustrating considering the amount of effort that got put into it. So interesting to think about where that report might have gone in 1985 under, but we faced you guys, especially on the international side, you faced more of those kinds of confrontations. And having Henry there at the the end of the aisle was very different from the kinds of management conflicts that we faced in later days.
Those are great comments, and they speak to all the things that you've talked about, including leadership, which Henry demonstrated every day that we worked with him, and he always told us, as some of my future bosses told me, don't be deferential to me. Tell me the truth, because that's what I need to know to do my job. So let's turn to some questions about financial regulation, a subject near and dear to Henry's heart, certainly to mine. And Henry commented in response to Kim's questioning about the risks of growing concentration in finance. And he stated his views very clearly, as always. And the question that I would put to you is the same that Kim put to Henry. Are the largest financial firms now much larger than when we were all together at Salomon Brothers? Banks or non-banks still viewed as too big to fail? Are they too big to manage? And if so, what should be done about it? And what other regulatory gaps need to be filled? That's a big question. Maybe I'll start with John, since you were at the IMF and in a policy position that was partly responsible for thinking about those in the FSAP and other exercises.
Yeah, absolutely. Well, I would say there's good news and there's bad news and there's a lot of uncertainty. The structure of financial markets has changed dramatically and continues to evolve. In the United States, the bank's role as a source of funding for the private sector has continued to shrink. And as someone's pointed out, bank balance sheets in the US now are concentrated on government securities and mortgage-backed securities. Basically, they finance housing and the government. And firms like private equity firms that were trivial back in our day when we were at Salomon are huge these days in terms of their funding of activity. When we look internationally, you could say there's been some there have been a series of crises that have had very deleterious effects, but have produced responses. Whether those responses are going to prove to be adequate is another question. But let me just lay out these factoids, and I'll leave Dick and Bob to talk about the domestic regulation, although the first thing I remember arriving at Salomon in 1984 is hearing Henry talk about the fractured and incoherent structure of the multitude of U.S. regulatory agencies over financial regulatory agencies. Something that I think is still valid and hasn't been cured one bit since that time. Internationally, however, to give shorthand, the Asian crisis showed the need for better coordination of bank regulation internationally and produced the creation of the Financial Stability Forum, and subsequently with the global financial crisis, the Financial Stability Board. In other words, there is a format that didn't exist before for an attempt to create a more coherent structure of financial regulations. And a key to that is not only regulations that encompass the whole financial sector, something I'd say there has been some but very limited progress. There has been an attempt to produce stronger regulatory agencies, at least that cover the banking system, and that's particularly true in Europe. There has been a lot of progress in creating resolution mechanisms that can deal with failing banks and other institutions, but there is still a long way to go before we can say that we have an international system that is completely coherent and makes sense. But we have made some progress.
In 1982, when Henry made his call, that also marked the beginning of securitization that was initiated by Louis Ranieri at Salomon Brothers in mortgages.
Correct.
And so, having witnessed the growth of the capital markets from that standpoint, how do you feel about these issues?
I'm sorry, you're asking me? Was that to
Yes.
me? I'm sorry.
Yes.
Oh,
Good.
yeah. Obviously, there's always been this tension, and Walter Wriston famously, who never had the greatest of warmest relationships with Henry.
It's in the book.
What's that?
It's in the book.
Yeah. I think what's his famous line about the piano player in the fancy house saying, "I didn't know anything was going on upstairs." Anyway, we were a very entrepreneurial place. Obviously, it wasn't whether it was tri-party repo or mortgage-backed securities or even in 1982, the introduction of certificates of accrual on Treasury securities, otherwise known as CATs, which we were not the first in, but certainly became the leading firm in terms of stripping bonds and opening up a whole new avenue for investors to take advantage of these high interest rates. There was always a tension about where does entrepreneurial innovation that serves efficiency and better resource allocation end, and where does fiduciary responsibility begin? And the firm always fought with it. It was obviously part of a big reason for Henry's ultimate departure from Salomon. And as he said, it's not easy to reconcile when, on the one hand, you want markets to be open and free, but when you build a system that rests on the notion that you're trying to protect the larger macro world from the worst types of risks, that always is going to involve trade-offs, and it presents this huge problem of size and the breadth of risk-taking. We used to say, well, it's not so much about size as it is about interconnectedness, right? And part of the problem we always have is, and we saw this front and center in 2008, we couldn't even size up risks where they were. I mean, they're just not always apparent, even when you're sitting there staring at balance sheets and commitments and security types. I mean, who really deeply understood the CDOs of ABS. I mean, that was a dense kind of structure that only became more apparent as the underlying collateral collapsed in value, and then suddenly all these relationships unwind. Repo market is, maturity transformation changed the whole sense of risk. I think Henry's probably ultimately right that something has to be done about size and concentration, but I'm always concerned that regulation is always too slow. It's it tends to focus on the last set of problems and not the next one, because as John points out, there's just this unbelievable evolution. The fact that fintech, for example, is now responsible for the bulk of personal lending. I mean, you think about what, the world that we grew up in. I think it has to, any kind of sustainable solution has to go somewhere down the path that Henry's thinking. I just don't know how you change it when the pressures are as great as they are.
Nick, you and I both served on both the buy side and the sell side, as we like to say, of the industry. And so let's hear your perspective about this question.
Well, I guess the way I think about it is go back to the early 1980s. There were 10 money center banks in the United States, 6 in New York, 2 in Chicago, 2 on the West Coast. And I still remember discussing with colleagues, okay, how many will there be by the end of the century? And our bet was there would be 3 left. Okay, who are the winners going to be? And so our bet was Morgan, Citibank, and Bank of America. Well, guess what? We got the names right. The problem is none of the institutions are really what those institutions were. So what I'm struck with is, when I ask the question, is there too much concentration? I think the answer today has to be yes, in that go back to the global financial crisis, pre-Dodd-Frank. And I think the largest institutions controlled 40% of the assets. So today, we've got, in addition to the 3 I listed, throw in Wells Fargo, and then you have 2 investment banks left. Think of it, 2. Okay, those 6 institutions control 60% of the assets of the financial system. And, inherently, I mean, this is where when Henry says they just all become too big, and even if you say, well, they're going to be financially sound, can those managements really know what's going on? And I really have more doubts about the ability to manage such behemoth institutions. So I've actually moved closer in Henry's direction. But the real question I ask myself, and I think it comes back to what John was alluding to, is the one counter argument that I do pay some attention to is, what about the shadow banks and the non-bank financial intermediaries? And is it kind of a counterbalance that we have? But I am struck by how concentrated we are at the top.
Well, that's exactly where I am. We can come to that, but I want to come to something else we talked about, which is conduct and culture in corporate governance and in the industry generally. And we talked about it in the context of research. What can we learn from the era of, which Bob described, of, pushing the boundaries of financial innovation, which we are doing today in some respects, from that era, and promoting integrity and responsible innovation and ensuring financial resilience today through those channels. Bob's shaking his head, which says, I don't know if there's anything to learn.
This is a real tough nut to crack, isn't it?
I don't ask easy questions.
Where do we begin? I mean, research. Research is shrinking, isn't it? I mean, I guess the idea that as things have evolved, obviously, what traditionally has been the focus of research has obviously mostly been concentrated away from what we all did and what's more involved in equity research. But a lot of that has obviously shifted to independent houses and boutique firms and that sort of thing.
Right.
And the big houses have concentrated on what is a relatively small share of the market.
Yeah.
And
Yeah.
so,
Yeah.
and yet even at that, I think it's probably shrinking, isn't it? I mean, in terms of the head counts and budgets, I mean, independent of the pandemic.
Yeah.
And you have a lot of these kind of overlapping or kind of cross currents going on in terms of, we think about what's ethical, what's proper management, what's proper conduct, and at the same time we've got issues surrounding disclosure and the walls we put up between research and the rest of these institutions. I don't think that there's a long. Again, I'm not the expert here. I don't see a long-term role for sell-side research in the way that we all kind of grew up with it. And even in the case of economics, it's not the same kind of economics that it was back in the 1980s. And part of that is, you look at what Henry went through. He asserted a kind of an independence, and we were fortunate because he had the authority. But in his absence, we didn't have that kind of authority. I can remember when Kim was running the show at Citi, we were coming out of I think it was after 9/11 and after the great telecom bust and the credit crunch of the early 2000s, and we had that kind of jobless recovery stretch, and we weren't particularly optimistic at the time. And we took a lot of flack from the chairman at the time and management about just, as Riston used to say to Henry whenever he saw him, "Is the world coming to an end today, Henry?" And of course, Henry would say, "Not as long as you've got access to the discount window, Walter."
Right.
And that's, that tension is, you just want to say, well, if you could somehow sell this, and I guess in Europe now, that's what they're doing. They're selling research for hard dollars, and that's one solution. But I don't know. I see the whole thing kind of atrophying over time, and maybe there's a way to find some equilibrium, but it just seems to me like it's a losing battle.
John, you've got your finger up. Yeah, I think the financial sector is becoming so much more diffuse. Mm-hmm. So you've got this complex, on the one hand, these central traditional institutions like the big next three surviving money center banks are a much larger part of the banking system, but a shrinking part of the entire financial system. And as a result, it's a little bit to me like you can say, well, the auto industry has shrunk so much in the United States, hardly employs as many, fraction of the people. And you look and say, no, actually, it's not true. It's just the big three's role is shrunk so much. There's a lot of other stuff going on, e.g. Tesla. But we've got that in the financial sector. And if you look around, the whole research effort has become much more diffuse. And I think, Bob, I agree 100%. The role of sell-side research, I think, is no longer what it was in our day. But hedge funds, private equity firms, et cetera, they've all got pretty, very sophisticated research efforts going on. And it strikes me, again, that going back to one of the simple conclusions, basic conclusions at the IMF of what was the cause of the global financial crisis and can we think that we're going to avoid another. One was that the perimeter of regulation didn't encompass a whole lot of systemically critical firms and activities. And you'd say, is that the case? And I'd say, I think so. I turned to Dick. You were had a critical role in trying to put together a greater understanding of the financial sector at the Department of the Treasury. It seems to me that we still the role of research in the financial sector is harder to put your arms around than it was, and I guess that could, on one hand, make you a little more uneasy, but on the other hand, it means that there are an awful lot of smaller voices around that are listened to rather than just the few highly concentrated firms.
Dick, I just thought too, I'd come back, not to financial structure, but you started with financial innovation, and it triggered a thought. And what was it that appealed to me about Salomon Brothers after having been at Mother Morgan? And apart from Henry and the research team, I think, and Bob alluded to it, Salomon Brothers was the laboratory for financial innovation, especially in the fixed income arena. And I worried at the time that being in a bank might have become a dinosaur because I didn't really understand what was taking place in the capital markets. So I still recall my first Monday morning sales and trading meeting that I attended. And I still remember on the dais was Henry Kaufman as head of research, Jim Massey as head of sales, and I think a guy named John Goodfriend that we haven't mentioned. So those were on the dais, but you had a parade of product specialists in 30 minutes coming and making their pitch. And I think my greatest sense of accomplishment at Salomon Brothers was the first meeting that I listened to. I might have understood 5% of what was said. And maybe by the final sales and trading meeting, so I left Solly in 1991, I don't know if I made it up to 50%, but it was an incredible place. And what you learn, by the way, is there's some true innovation. And let's face it, there's a lot of marketing gimmicks that isn't really innovation. And what I learned in my career, especially when I had to manage money, was what is real innovation versus what's just marketing hype. And I think the number one rule I used that served me well was if I don't understand it, I'm not investing in it. But there was a lot of pressure leading up to the financial crisis that if you didn't understand it, you were a dinosaur. So I would leave you.
Yeah, thank you. That's why I talked about responsible innovation, because that's something that, having been in part of the regulatory process, that was important to us and still is. Well, we're almost at the end here, but I wanted to close with any final thoughts you guys might have about some of these topics, our engagement with Henry. I'm not going to ask specific questions, but I would just say, and if you have any questions for me, feel free to ask them.
Dick, okay, go ahead, Bobby.
Go ahead. I wanted to ask you, because we didn't really touch on it that much, but the flip side of the secular turn in interest rates was, what most people remember as the start of the great bull market in equities,
right?
And what became the great moderation, John Taylor's words. I remember in those days, and I've told you this many times, that we could have used your insights as a macroeconomist in that period, because we were not optimistic enough at Solly about the recovery's initial strength. And I'm curious as to if you could share with us where did you come down, and in that period? And what do you remember about the growth debate, especially in the wake of these big market moves that we had over the summer and fall of '82? Because my sense is that my memory is that there was that the recovery took most people by surprise, the strength of it right out of the gate. And at Salomon, I think Henry was, focused a little bit still on these residual fragilities and such. But obviously, there was a lot of pent-up demand. We had permanent tax cuts. You had demographics working for growth. I mean, I don't want to step on you, but what were yours? Where did you come down, and kind of how did you see that debate affecting your thinking at the time?
Well, one of the things that was so important, having spent time at the Fed up until 1980, and having, ushered or been present when Paul Volcker came in to break the back of inflation, and listening to the conversations and contributing to them to some extent at that point in time, the permanence of the decline in inflation and the credible commitment of monetary policy to keep inflation down, I think, as you said earlier, Bob, really changed the game. Because in the past, what we'd worried about in the 60s and 70s was that we hadn't paid attention to inflation rising, and the Fed, and Ben Bernanke's favorite words, recessions didn't just happen. They happened because the Fed murdered the economy, and they did it to bring inflation down, but didn't bring it down in a sustainable way. And here, for the first time, we had inflation down in a sustainable way. I can remember at the Fed, as advisors, we had Franco Modigliani and Albert Ando, two professors, one of whom was mine, who would come in and say, how come the stock market is doing so poorly in the 1970s? And to me, it was pretty obvious, quite frankly. I was shocked that they didn't hear these titans of finance. Yeah. Inflation was high and uncertain, and the inflation premium in equities was pretty spectacular. So bringing that inflation risk premium down, and bringing in and having a credible commitment to keeping it down was really good for growth and good for equity valuations and equity markets. And then the other thing was, we had, speaking of leadership, whether you liked it or not, we had leadership that was very pro-growth, that promoted, tax cuts and recovery, and the use of monetary and fiscal policy in a coordinated way to promote growth. So I think that was also a factor in thinking. But I think they added up to something that was going to be likely much more sustainable than what we'd seen in the past. All along, though, I have to say that, having been at Salomon Brothers with all of you, that one of the things that always was in the back of my mind was, and this came out of the Great Moderation and my thinking about it subsequently, even though we'd promoted an environment of economic and price stability, meaning in plain English, sustained low inflation, had we promoted an environment that led to financial stability. And I think we made the mistake of thinking in the Great Moderation that those two things were at least highly correlated, if not causally, related. And that proved to be a big mistake.
And actually, and don't forget the international aspect, especially.
I was waiting for you to bring that up, John.
In the early 80s, you remember that there was, as I described earlier, the rest of the world wasn't looking very good. And all of a sudden, the US started gaining credibility for the reasons that we've all cited. And remember that by 84, we were in the midst of the period of the superdollar, as foreign investors, especially Japanese investors, were liberated to invest in foreign securities, and there was a rush on. Everybody wanted US securities. The dollar went up, helped pressure, keep inflation down in the US, and of course, helped lower interest rates that were going that way anyway. and it was self-perpetuating, at least for a while.
Right. Nick, any final thoughts? Because we're just about out of time here.
No, the only thing I was going to leave you with is that, again, memories of Henry. I'm surprised none of us have said, if there's one phrase that has influenced my thinking, it's Henry's famous maxim, money matters, but credit counts.
There you go.
Here.
Words to live by. Well, this has been a great discussion. Thank you all very much. As we all said, this is a wonderful event to honor Henry and to think about how he's influenced our lives and our careers and shaped our thinking. And I can't imagine a better environment in which to have that celebration. Thank you all very much.
Thank you. And thank you, Henry.
Thank you, guys.
Thank you.
Well.
Thanks, Henry.